This question I got here from Michael Oyeko is asking about fundraising. How do you qualify for a bank loan from the bank? Let me say this first. Most people who are trying to raise money don't have any idea, have not yet thought about the kind of money they want to raise. I've seen some people who say, I want to raise $100,000. And you ask them, what type of capital? Do you want it as loan? Do you want it as equity? And they tell you it doesn't matter, anyone, that they will take anyone. And this is a common mistake that entrepreneurs make. They are too focused on the money that they are not thinking of the implications of the kind of money they want to take. You may take $100,000 as equity, and another person takes $100,000 as a loan. Those two are very, very different. Those two are very different. So when you think of a loan, the first place to think of are the banks, and it makes sense. Banks are the biggest players in the credit industry. It makes a lot of sense. But one thing you should realize for a loan is that loans thrive on cash flow. That's why banks don't give money to startup businesses. You may have a beautiful business plan. You may have a fantastic idea that will make millions of dollars. A bank will not give you money. Why? Banks are looking for cash flow because the only way a loan will be paid back is from cash. So if banks don't see that you have the cash, they will not give you the loan. That is why businesses that easily get loans from banks are businesses that have transaction volume. The banks are seeing how money is coming in and going out of your account. So when they look at your transaction volume, they can now say, okay, this person has cash flow. He can pay back the loan or she can pay back the loan. And then based on the volume of your cash flows on your account, they can then compute how much they will give you in terms of a loan, right? So if you don't have cash flow, don't touch a loan. What does this mean? If you are a startup business and you want to get funding, it is dangerous for you to take a loan. And why? When you want to start a new business, particularly a business you don't have any experience in, that you have not done before, the dream you have in your head is different from the reality on the ground. You may start that business, you may not make sales, you may not make as much sales as you expect, or you may make sales, but the business may not be profitable. There are a lot of things that can go wrong with a new business. But when you have taken a loan means, this is what a loan means. A loan means you must pay back this money, whether you make money or you don't make money, whether the business survives or dies, whether your business succeeds or doesn't succeed. A loan is an obligation. An obligation means you must pay it back. That's what a loan is. So it doesn't, you can't, for example, you cannot say, I'm sorry, the business didn't work out, I can't pay back the loan. That can't happen. It doesn't work for a loan. It doesn't work for a loan. But if it is equity, you can say that. Because equity means you are sharing risk with the investor. Equity means the investor only makes money if the business makes money. So if the business doesn't make money, the investor can't make money. So you can tell an equity investor, I'm sorry, the business didn't work out, I lost your money. It's possible. Technically, you can say that. But you can't say that for a loan, because a loan must be paid back. Yeah? So that's it for the difference between a loan, taking a loan, and taking equity. On the flip side, if you started a business, you've done all the hard work, made all the sacrifices, it was difficult for you to make sales, but now you are making sales, money is coming into the business, you are finally in a cash positive situation. It doesn't make sense for you at that time to go for equity. Why? Equity means that the person will take a slice of ownership in your company. So for example, you may be asking for $100,000 and the investor will tell you, I'll give you the $100,000, but I want 60% ownership of your company. How many people on this call will accept that deal? That somebody gives you $100,000 but takes 60% of your company. For many of us, the pride of being in business, the pride of being an entrepreneur is that you are your own boss. You control your business. You call the shots. So if somebody takes 60% ownership of your business, essentially they have control of the company. And indirectly, you now have a boss. That's what it means, even though you founded the company and you own the company. So control for some people is very important. So you may want $100,000, but what are you willing to give in exchange for that money that you're asking for, right? But that's for equity. For a loan, the bank is not interested in taking any share of your business. The bank is not interested in having a seat on your board of directors. If your business gets into trouble, you cannot go to the bank and say, I'm having trouble with distribution. I'm having problems with my suppliers. I'm having problems with making sales. Can you advise me? Can you help me? That's not the bank's business. Why? Because it's a loan. A loan means take this money, do what you want to do with it, but you must pay it back. So you have more flexibility with a loan. But with equity, equity means take this money. I'm not walking away. I'm going to sit close to you. I will take part ownership of your company. I will sit on your board of directors. I will be part of major decisions that you're going to make in this company. So that is the trade-off that you need to make.